Now, economists don't like the D word, the word depression, because it doesn't have a rigorous mathematical definition. You can't plug it into a closed form equation. It works exactly the way I described. And by the way, my source on that is John Maynard Keynes. So if it was good enough for him, it was good enough for me. But that's how he described a depression. So I would say we're in a depression, so have been since 2007. That even periods of growth are well below trend, well below potential. A lot of wealth, trillions of dollars of wealth being left on the table. We're in a technical recession right now. We'll see if it gets worse. My expectation is it will, but that remains to be seen. So, but the White House would say, we haven't had a depression since the 1940s, and we're not in a recession. So, pick your experts, but the White House and the government don't have a very good track record of this.
Back to the Wiggin Sessions. I'm your host, Addison Wiggin. I have with me again Jim Rickards, author of Currency Wars and The Death of Money, among other books. We were talking about the rise and fall of the Bretton Woods exchange rate system, and then we were rudely interrupted by an internet outage. And so we pick up today with part two. Jim was bringing us current to today, the market today. And what I'm going to ask Jim, welcome back, first of all.
Good to be with you, Addison.
Yeah. The first thing I want to ask is we had a rather lively discussion about the difference between recession, depression, and financial crisis, which I thought was being recorded, but ended up not being. So I'd like you to pick it up there and answer the question, why does the dollar rally during financial panics?
Well, a great compound question. So let me separate a little bit and we'll kind of unpack it and look at all those things quickly. So the difference between a recession and a depression, this is not well understood. Recession is very numeric. There is a referee, something called the National Bureau of Economic Research, based in Cambridge, Massachusetts. It's a panel of, I believe, 9, kind of PhD level economists. And they decide when a recession started and when it's over, and therefore when the recovery began, et cetera. They're not an official body. They're not they're organized, but it's not a government body. It's a private body. But the government kind of goes along with what they're saying. But even when they call it, it doesn't, it's their opinion and people are guided by that. But just to be clear, it's not a government agency making these decisions. Their rule of thumb is 2 consecutive quarters of declining GDP. That's the rule of thumb. Now, there's more to it. They look at unemployment. They look at, incomes. They look at a number of other factors. But based on the rule of thumb, we're already in a recession. The U.S. had declining GDP in the first quarter of 2022. We had declining GDP in the second quarter of 2022. That was just revised literally today, but the loss was not as big, but it's still a loss, still in the red. So we've had the 2 consecutive quarters of declining GDP through, at this point, several revisions by the U.S. government. So based on the rule of thumb, we're in a recession. Now, Janet Yellen, who doesn't know much about this, in the White House and others are saying, well, we're not in a recession. They're either changing the definition, or if you want to be a little technical about it, the National Bureau of Economic Research hasn't said so. But that's not unusual. What's normal is that the National Bureau of Economic Research can wait 3 months, 6 months, sometimes a year before they call the balls and strikes. And for that matter, it's not unusual that the recession's over before they tell you it started. So I don't expect to hear from the National Bureau of Economic Research until late this year, maybe early next year. And oh, by the way, wouldn't it be interesting if they waited until after the election? So don't underestimate the political twists and all this. I mean, that's definitely there. So I'm not waiting for them. I've seen the 2 consecutive quarters. I believe it's getting worse. The Atlanta Fed, Federal Reserve Bank of Atlanta, has a tracker. They're showing the third quarter of 2022. We're in the third quarter, won't be over until the end of September. They're showing that in positive territory, but it's been trending down from about 2% to 1.9% to 1.6%, et cetera. That's also not unusual. They have a very interesting statistical method. I give them a lot of credit, but what they do, everyone on Wall Street takes the data. Yeah, the GDP data comes in, some of it weekly, monthly, quarterly, whatever, and you got to get all the data before you make a final call. So what Wall Street does, they take the data they've got and they extrapolate. They say, well, based on regressions and correlations, et cetera, we think it's going to end up like this, and they're usually wrong. Atlanta Fed does something different. They take the data you've got, instead of extrapolating it, they say, well, what if this is all we had? What if this was the only data we had? And without guessing as to the unfilled pieces of the jigsaw puzzle, we'll give an estimate based on what we know. And that's what they do. But one of the results of that is the estimate, again, it's a rigorous method, but the estimate tends to decline over time because the pieces that they're waiting to get filled in are if you're in a recession and it's getting worse, by definition, the bad pieces are going to come in later in the quarter. So we saw this in the second quarter. They started positive and ended up negative. They started positive in the third quarter. It's trending down. We'll see where it ends up. I don't have to call it the third quarter, but it wouldn't surprise me if we're saying the recession continue into the third quarter, even as the National Bureau of Economic Research tries to make up their minds. So in my view, we're in a recession, but there's no, again, just to be clear, we all have our views. There's no government agency saying who's right or wrong. They don't do that. A depression is completely different. People say, well, okay, if a recession is 2 quarters of declining GDP and a depression is worse than a recession, then a depression must be, 10 quarters of declining GDP or something like that. That's not true either. First of all, you can have growth in a depression. And we did. The Great Depression is conventionally dated from 1929 to 1940. It was a severe technical recession from 29 to 32, and then early 33, and then another technical recession in 37 and 38. But from 1933 to 1936, the economy grew. Now, the problem was it was growing from a very low base. In other words, unemployment in the first term of the Roosevelt administration went from like 22% to 12%, but it was still 12%. I mean, 12% was an improvement, but nothing to write home about. So the point being, a depression does not mean continuous declining GDP growth. What it means is depressed growth below trend. So if your potential is 3.5%, 4%, which it probably is in the United States, it's not necessarily higher than that, except for short periods of time. But if your potential is, 3.5%, 4%, and you're growing at 2%, which, by the way, from 2009 to 2019, average annual growth rates were 2.2%. We had 10 years of 2.2%, and not a lot of variance around that. There were no 5% quarters, and there was one mildly negative quarter, but it really kind of crowded around that central tendency. But if your potential is 3.5 and your actual is 2, then you have depressed growth. And imagine 2 curves, one's going up like this and the other one's going up like this. That gap between potential and actual, that's depressed growth, that's lost wealth. It's now well into the trillions of dollars of lost wealth because we're in a depression. I would argue we've been in a depression since 2007. Now, economists don't like the D word, the word depression, because it doesn't have a rigorous mathematical definition. You can't plug it into a closed form equation. It works exactly the way I described. And by the way, my source on that is John Maynard Keynes. So if it was good enough for him, it was good enough for me. But that's how he described a depression. So I would say we're in a depression, have been since 2007, that even periods of growth are well below trend, well below potential. A lot of wealth, trillions of dollars of wealth being left on the table. We're in a technical recession right now. We'll see if it gets worse. My expectation is it will, but that remains to be seen. So, but the White House would say, we haven't had a depression since the 1940s, and we're not in a recession. So, pick your experts, but the White House and the government don't have a very good track record of this. Now, as that relates to the dollar, people say, well, okay, we have massive budget deficits. We have for a while, but they're now multiple trillions of dollars per year. The baseline deficit going into the Biden administration was $1 trillion a year. When I say baseline, it's like that's what the deficit would be if you didn't do anything. You just kept all programs going and taxes about the same. But they piled on, well, actually going back to Trump in the pandemic, there was there was a $2 trillion relief bill in May, June 2020. There was another approximately $1 trillion relief bill at the end of Trump's term in December 2020. Biden comes in, he's like, well, I can top that. You know, Trump had his relief bill, I'll have mine. And we had the American Recovery Act, or whatever they called it, in February of 2021. That was about another $2 trillion on top of that. Then we had the infrastructure bill that was just under $1 trillion. Now we have they stopped calling it Build Back Better. That was the worst marketing campaign in history. But the Inflation Reduction Act, which will actually increase inflation, but that's about another $1 trillion. And we just had $300 billion of student loan forgiveness. Sounds, you know, like peace, love, and understanding, except the taxpayers have to pay that. When you forgive the student loans, it goes into the budget deficit. People don't understand the accounting, but that's how it works. You don't have a deficit when you make the loan. It's carried on the books as an asset. But if you forgive the loan, you have to write it off. And then that does hit the deficit at that time. So we're talking about, at this point, $5 or $6 trillion on top of the $1 trillion baseline deficit. The U.S. GDP, debt to GDP ratio is up around 130%, going higher. And if you said, hey, look around the world, who's at that lunch table? Like who else has like 130% debt to GDP ratio? The answer is Lebanon, Greece, and Italy. So that's your lunch table. This is the peer group that the United States is in. Not counting Japan. Japan's in a world of its own, but they're much higher. But that's what the modern monetary theorists say. Hey, look at Japan. They're 300%. We could triple the debt, and it's all good. That's not correct, but that is what they say, and Congress is acting that way. So with all that, budget deficits, trade deficits, high debt to GDP ratios, out of control spending, et cetera, why is the dollar strong? People are like, well, hey, people should be getting out of the dollar. It looks like the end of the world. Well, it's not. And here's why. Because there's a dollar shortage around the world. And people say, how can that be? You know, the Fed printed, $7 trillion of money, M0, actually higher than that. I think it went up to 9 trillion. They just flooded the zone with money. And the answer is yes and no. Yes, they did print, over $7 trillion of base money, so-called M0. But that money didn't go anywhere. The Fed, how does the Fed print money? Well, they buy bonds from dealers, from the big banks, the so-called primary dealers. So the open market desk at the Federal Reserve Bank of New York calls up Goldman Sachs, they offer me 10-year notes. Goldman says, here's a price. Okay, done. Goldman delivers the notes to the to the Fed, and the Fed pays Goldman. And that money comes out of thin air. That is money printing. But then Goldman takes the money and gives it back to the Fed as excess reserves. It doesn't go into the real economy. Nobody borrows it, nobody spends it, nobody lends it. All that happens is at the Fed, you're building up both sides of the balance sheet. You're building up the asset side with U.S. Treasury securities, and you're building up the liability side with deposits from the primary dealers in the form of excess reserves. So that money doesn't do anything. I mean, it's printed, if you want to say that, but it has not caused inflation. The inflation comes from, as I discussed earlier, from the supply side. The price of oil, supply chain disruptions, wheat, food, gasoline, et cetera. The inflation is flooding in, and it's exacerbated by fiscal policy. Now, you have to, what I just described about the money printing, that's monetary policy. Okay. But fiscal policy, which is the 5 or 6 or probably $7 trillion of deficit spending, that's helicopter money. When the federal government and the Congress and the Treasury hand out checks, that's helicopter money. That's not like giving Goldman money and then Goldman gives it back to you. Forget that. It doesn't do anything. The minute it exists, it doesn't do anything. But when the government hands out checks, that's real. Now, some people saved them during the pandemic. A lot of millennials opened accounts on Robinhood and started trading cryptos. They could, kiss that money goodbye. But more recently, that money has been spent, and particularly the Biden bill. I don't want to single out Biden for political reasons, but what Trump did in 2020 probably needed some of that. The payroll protection or the paycheck protection plan that was almost $1 trillion. That really did keep the economy from completely going down the chute. But we didn't need that in January and February 2021. And Larry Summers, to his credit, said so. He said, hey, we've had enough stimulus. We're growing. Let's not throw more money out of the helicopter. But they did. And that's when the inflation really took off. So that was driven not by monetary policy. It was driven by fiscal policy. But getting back to the strong dollar, there's something else going on, which is the entire international monetary system is driven not by the Fed, but by Eurodollars, by money that banks lend to each other so that they can support their balance sheets and lend to customers or offer transactions to customers if they will. And the main transactions, the 800-pound gorilla, if you will, is approximately $1 quadrillion of derivatives, options, futures, forwards, swaps, swaptions, I could go on and on. By the way, for those who aren't familiar with the term, a quadrillion is 1,000 trillion. So we've got about 1 quadrillion or 1,000 trillion dollars in derivatives. All of that, almost all of it, has to be backed up by collateral. I could say, if I'm a hedge fund and you're Morgan Stanley, and I call you up and say, Addison, I want a $5 billion total return equity swap, which is basically a derivative basket of stocks, and I can buy and sell stocks all day long, up to 5 billion. But it'll be notional. You'll pay me the profit or loss and dividends, but I don't actually own the stocks. I just have a $5 billion swap with you. And then you go out and maybe buy the stocks and hedge your position. Okay, you'll do that for me if I'm a big enough hedge fund or sovereign wealth fund or institution or whatever. But you want collateral. I don't have to give you $5 billion worth of collateral. I just have to give you enough, a little bit of a foundation and the mark-to-market losses. So if I lose money on that deal, I will give you that much collateral, until such time as we close it out, et cetera. So collateral is the key to the whole quadrillion-dollar structure I described. What can be collateral? Well, basically securities. But we're in a stage now where banks are and hedge funds and others are becoming suspicious or nervous about each other's credit. In other words, these are the early signs of a global liquidity crisis, which is different than a recession and different than a called a plain vanilla, financial crisis. The liquidity crisis, is when you get ready to turn off the lights. So what's good collateral? Well, it used to be a lot of things, but today banks are saying to each other or to their clients, we don't want your corporates. We don't want your stupid mortgages. We don't even want treasury notes that are past like 2 years. We want, 2-year treasury notes, maybe with a haircut, or, 6-month bills, 4-week bills, 30-day bills, the best, absolute best, most liquid form of collateral. Well, okay. First of all, there's a scarcity of that. There's a collateral shortage, and banks desperate to prop up their balance sheets are out. We're going to get some treasury bills, and they're bidding for them at prices that produce yields to maturity lower than what the Fed will give you for free. So if I'm a bank and I can call the Fed, and the Fed will give me some treasury bills, and I give them cash under an agreement to unwind that, and the interest rate on the cash is whatever, why would I go out in the market and bid on a treasury bill that pays me less than what the Fed will give me for a phone call? Why would you do that? The answer is you need the bill. In other words, you don't need an expanded balance sheet. You don't need more credit at the Fed. You need that bill to pledge as collateral on this quadrillion dollars of derivatives. And that's what's happening. So how do I get a bill if I'm Deutsche Bank or Credit Suisse or UBS or Unicredit or Barclays or anybody else? I need dollars. That was the bills are denominated in dollars. So if I want to buy them, I got to get some dollars. So there's this huge bid for dollars that can be used to buy the treasury securities, to pledge as collateral, to prop up the balance sheet. And that's what's going on behind the curtain. That's the plumbing. That's why the dollar is strong, even though everything about the U.S. economy is weak, meaning recession, long-term depression, deficits, trade deficits, political dysfunction, borderline civil war. It's all bad. But if I'm Deutsche Bank, I need those dollars to buy treasury bills to prop up my balance sheet.
So in that sense, the dollar is divorced from the fundamentals that generally back up fiat currency.
Correct. Completely divorced. You could say it has been since 1971, but with good management, with the, Henry Kissinger and the petrodollar deal, and James Baker with the Plaza Accord and the Louvre Accord, and Alan Greenspan, the maestro, and all that, and good growth during the 90s, with everything of Bill Clinton. We had the one of the longest, strongest expansions in U.S. history. Despite all, so that's the kind of the good news, and very low inflation. I haven't really seen much inflation until recently. In the past year is different, but from 1982 to 2021, there just wasn't a lot of inflation. In fact, they were a little bit about deflation. So yeah, all of a sudden, the confidence in the dollar, which was maintained, notwithstanding the absence of the gold standard, is, one would think, starting to erode, except we're in this crazy situation where we're so highly leveraged that people need the dollars to buy the collateral to prop up the balance sheet. But if you can't get it, or you can't get it at a price, or the dollar gets too strong, et cetera, or the yields get negative, et cetera, what happens is, and this is happening, the banks are reducing their balance sheets. And it's just a matter of time, in my view, not guaranteed, but one could see a situation where suddenly some major player goes bankrupt. They can't meet a collateral call, or a bank gets in distress, or there's a run on the bank. Now we're back to 2008. This wouldn't look like 2020. This would look like 2008, except worse.
We're speaking today on the eve of Chairman of the Fed, James Powell's speech at Jackson Hole. That's their annual economic policy symposium,
right?
Where they talk about, well, this year, the major topic on the table is 40-year inflation highs across all currencies. The euro is going through it. The UK pound is going through it. One of the things that we have been discussing is that the inflation that we see in the economy right now is largely on the supply side, and the Fed is really just powerless to do anything about it. There's a lot of talk about raising rates to slow demand down so that supply can catch up with demand. Can you break that down for us so that we can understand exactly what the difference between supply side inflation is and demand side inflation?
Sure. The supply side, we kind of talked about. So energy shortages because of the Biden energy policy, empty shelves, supply chain breakdowns, bottlenecks at the Port of Los Angeles, not enough truck drivers, higher fuel prices get passed along. I mean, there's everything arrives by truck at the end of the day. It could come by boat or train, but it's somewhere in that delivery chain, those transportation channels, there's a truck, and they run on diesel. And when the price of diesel goes up, the price of everything in the truck goes up, because you got to factor the delivery costs into the cost at the counter. So that's kind of what's going on from the supply side. Demand side inflation, what's called demand pull inflation, is mostly psychological. In those consumers get it in their heads that prices are going up for whatever reason. Maybe they actually are going up and they extrapolate from that, or they have other reasons for believing that. And so what they do is they pull demand forward. And I lived through this in the 70s. This was what was happening in the 1970s. You want to buy a refrigerator or a car, or a new suit or clothes or anything. And you go, you know what? I better go buy it now, right now, because it's going to be, if I wait 3 months or 6 months, it's going to be a lot more expensive. So you do, but what you're doing, you're pulling all that demand forward, and it feeds on itself. Prices are going up because there's more demand, possibly combined with supply shocks. And then when the prices go up, it validates the narrative. It's like, oh, see, I told you, prices went up, better go buy more. And it just feeds on itself. So, but they're very different. So the Fed, it's one thing to say the Fed can't do anything about the supply side inflation, if that's what it is. I mean, higher prices, yeah, it's inflation as we measure it, but is it real inflation or is it just a logistical problem? But the Fed can't do anything about it. The Fed doesn't drill for oil. They don't drive trucks. They don't pilot ships, and they don't work farm equipment. They can't do anything about it. They can do something about the demand side, which is destroying demand. So now we're in a situation, by the way, we're not all the way to demand pull inflation yet. In the 70s, it also started on the supply side with the Arab oil embargo in 1973. Then there was a second embargo in 1979 from the Iranians. So those supply shocks did tip over into the demand side, and then it just has a life of its own. We're not at that point yet. We're getting dangerously close. We definitely have it from the supply side. It hasn't yet affected the consumer side of it. In fact, consumers are pulling in their horns. I mean, they say the cure for higher oil prices is higher oil prices. In other words, if the price goes up, people will drive less. Or if you lost your job, you might not be driving at all. So there's another way for those prices to come down, which is the high prices themselves destroy demand by themselves. And then that results in lower prices. And that is happening. We have seen inflation come down a little bit. I know it was higher than a lot of people expected beginning in the middle of last year, but they are starting to come down a little bit right now. But we haven't, but the demand side of it has not yet caught fire. But there is something else the Fed can do. They can destroy demand. In other words, so how do they do that? Well, raising interest rates. So what happens? Credit card rates go up, mortgage rates go up, new housing purchases slow down, car financing, leasing rates go up. So people stop buying new cars, et cetera. If you do that enough, you can destroy demand, but it's at a very high cost, because what are you doing? You're putting the economy in a recession. So can the Fed deal with supply side inflation? The answer is yes, by destroying demand and putting the economy in a really severe recession. So nice job, Fed. So that's between a rock and a hard place. Let it go. And it'll take a long time to fix the supply side, or crush demand so much that it fixes itself, but at a very high cost. And the Fed is doing the latter. It's a very, very imperfect, blunt instrument, but they are destroying demand. Now, so here's the policy question. Does the Fed know what they're doing? The answer is always no. They never know what they're doing. They pretend they do. They say they do, but they don't really. Do they understand what I just said? Not really. So what are they going to do? They're going to keep raising rates because they got to crush inflation. Jay Powell does not want to be remembered as the new Arthur Burns or William McChesney Martin. He wants to be remembered as, if anything, the new Paul Volcker. And that's what Volcker did. Leave aside whether that was really the problem, but that's what he did. So Powell is going to keep raising rates, and they may raise them 75 basis points in September, again in November, again in December, into 2023. And you're like, wait a second, Jim, you said we're in a recession and unemployment is going to start to go up and there's demand destruction because of higher interest rates, and that may result in declines in housing prices. The inflation may cool off. So why is the Fed raising rates into weakness? And the answer is because they don't get it. They're always the last to know. And they're very political. Don't let anyone tell you the Fed's not political. So here we have the situation where the inflation is coming from the supply side. Fed can't do much about it. They can destroy demand, but that'll throw us into a recession. So why are you raising rates into what may be both a coming recession and a global liquidity crisis, which we just talked about? The answer is that's crazy. You shouldn't do it, but it's the Fed and they probably will.
I just have one last question for you, Jim, and I appreciate you taking the time to catch up after our interruption last time. And I know you got to go, but you launching a new product, and it's based on a financial model that you helped develop with the CIA following the 9/11 attacks. Can you describe what the process was that you were involved with the CIA, and what the model can help individual investors understand about how markets work and and apply similar thinking to their own investment strategies.
Sure. There was massive insider trading ahead of 9/11. That's not a conspiracy theory. You can see it in the data. I spent a lot of time with John Mulheron. John was a legendary trader on Wall Street, kind of the founding father of block trading back in the early 70s. John had a firm, and he was the special New York Stock Exchange member, and he was the specialist market maker in American Airlines and United Airlines, the two stocks of the companies of the planes that were hijacked. He was the market maker. And he said to me, he said, Jim, I never saw a more blatant case of insider trading in my life. And it shows up in the data, massive buying of put options, because they're more leveraged, et cetera, in the last 2 trading days before 9/11. It's all there. And we traced it to it's not like Muhammad Atta, stopped at Charles Schwab on his way to Logan Airport to hijack the plane. Nobody's saying that. It's more the case that even terrorists exist in a social network. They have a mother, father, sister, brother, cousin, whatever, safe house operator, driver, and who know about this. And they go, hey, I can make some easy money, call up and buy the put options. And they did. The CIA is not a criminal enforcement agency. That was left to the FBI and the SEC. But the CIA is an intelligence operation. And so we said, well, if it happened then, and there was going to be a new terrorist attack, another terrorist attack after 9/11, because that was the CIA's job, would there be insider trading again? Could you spot it, call the broker, trace it to the source, get a warrant, break down the door, and stop the terrorist attack? That was our mission. And we concluded that the answer to every one of those questions was yes. So we were inventing systems that could infer terrorist activity through market information. So I was not, as they say, jumping out of a helicopter with a knife between my teeth. I was part of a team of subject matter experts, psychologists, applied mathematicians, and others. And we built the system, and it worked. It worked brilliantly. It worked better than we thought, because we said, hey, we're kind of building a go-kart. If you want a Rolls Royce, that'll cost a little more money. But it turned out the go-kart was a Rolls Royce. It worked really, really well. So all I've done is taken that intellectual property and that experience, brought it into the private sector, and developed models that are much more sophisticated than what we did for the CIA. What we did for the CIA was new. We were the first people to kind of be doing it. But because computing power has expanded, computing power is much cheaper, sources of information are greater. There's been advances in the intellectual property, and I've been part of that along with others. The system we have now is light years ahead of what we built in the early 2000s. Even though that system worked very well, these new systems work even better. So what we're doing, what we discovered is that we were building a counter-terrorist tool. But if you could draw inferences about behavior and predictive analytics based on market signals, it didn't have to be confined to terrorism. You could do geopolitics, you could do wars, you could do trends, you could do insider trading, sleazy insider trading. Don't be an insider trader yourself, but if you can spot it and trade on it, that's not insider trading. That's perfectly legal. So the point being, we're there, we have these models, we use them. And what we're doing is we're looking at the Fed because they meet on a regular schedule. And it's not that the Fed is all powerful and all knowing, but even when they make mistakes, if you can know that they do make mistakes, what the mistake is and how it's going to play out, it's not just a matter of predicting rate increases. We can do that almost flawlessly because the Fed tells you all you have to do is listen to them, know where to look, listen to them and say, okay, they're going to raise whatever, 75 basis points in September, let's say. And by the way, we'll update that. So, check in with me in mid-September. But as of now, that's what it looks like. But the hard part is, okay, knowing that, where does that go? What's the impact on markets? What's the reaction function? How does momentum play? What about the fact that 95% of the trading on the New York Stock Exchange is robotic, based on algorithms and natural language processing and high-speed processing? Well, you need to know that to reverse engineer it to figure out what's going to happen next so you can do better yourself. So that's what we do. Yeah, we're very excited about the product. We have a newsletter, Countdown to Crisis. We have another one called Strategic Intelligence. and both of them use that toolkit.
Great. All right. Thank you, Jim, again. Thanks for joining me again after our interruption. And I'll check back in with you once we get closer to the next Fed decision. It'll be interesting to see what James Powell says tomorrow at Jackson Hole.
Yeah, I think it will. I think we can count on him to talk, take a tough line, but we'll see what happens as he's, as they say, data dependent. We'll see how it plays out in September.
All right. Great. Thanks, Jim.